I call this meeting of the House Housing, Finance, and Policy Committee to order. We do have a quorum. So welcome everyone to this hearing of the Housing Committee. I'm excited to be back and working together on multiple different initiatives that will be starting to fledge out in the weeks ahead. So today we just got a relatively simple agenda. We're going to be getting some updates and reports on where things are at. One from our wonderful agency folks, and then one from our realtors here in the state. But before we get into anything, I do need approval of the minutes. Would someone like to move the minutes?
So moved.
Co-Chair Howard moves the minutes. Any discussion? Seeing none, all those in favor of approval of the February 18th minutes signify by saying aye. Aye. Opposed? The minutes are approved. All right, our first testifiers up today is our Commissioner Ho, who will be presenting from Minnesota Housing Finance Agency. So with that, please introduce yourself for the record and then proceed with your presentation.
Chair Igo and members of the committee, I'm Jennifer Ho. I'm the Commissioner of Minnesota Housing. I'm here with Dan Kitzberger, my legislative director, and I have a couple of my other legislative staff over here in the second row with me today. Thank you for the invitation to speak specifically about the 2025 program assessment that we sent over to you, maybe even just last week. Time is a little bit of a blur right now. This is one of the reports that we present to you on an annual basis. And what it does is it looks back at all the activity of the agency in the previous federal fiscal year. We operate on all three calendars, state fiscal year, federal fiscal year, and calendar year, but this is for the federal fiscal year. When we talk about selecting projects for funding, we often talk about units that won't actually be built and come online for sometimes 2 or 3 years to come. I think that's important when we understand the impacts, especially of a large investment like we saw in 2023. I think you all have a hard copy of the report in your information. And I'll tell you, if you like numbers more than words, you're going to love this report. There's a lot of numbers that's in this one. So I think that it's important to contextualize that this is still reflective of your large investments in the 2023 session. So it's important context. Our base funding, it is a much smaller amount than we had. In 2025, we served nearly 73,000 households, which is about 3% of households in the state. And we had resources of $1.8 billion across all our program areas, from homelessness to homeownership. Some things move fast. Family homeless prevention and assistance, down payment assistance. Those dollars are kind of more transactional with individuals. They move fast. The development dollars move slower. So just, again, keeping that in mind. So to contextualize this in terms of just Minnesotans and their housing needs, about 241,000 renter households are cost burdened, which means that they pay a large portion of their income on rent, which doesn't leave a lot for other things. About 53,000, well, exactly 53,843 received assistance through the agency and our partners. About 191,000 renter households are potentially income ready to buy a home. 9,300 received homebuyer education, and 5,619 bought a home. So, home ownership lending is a large part of what we do. We do affordable mortgages for first-time homebuyers and folks who are buying their second home. We provide down payment assistance to help people who don't have a large cash asset but have the income to sustain a mortgage. We do affordable home improvement loans for folks who are lower income and oftentimes need home improvement projects in order to keep their homes safe, many of whom are seniors that are aging in place. We do homebuyer education, counseling, and training. You might hear that referred to as HECAT. That's to help people who are thinking about buying a home to better understand what it takes and to prepare to buy a home. So in our home ownership lending, the mortgages that come through the Minnesota Housing Finance Agency represent about 8% of the state's total mortgage lending by number of loans. We've seen a 62% increase in our lending activity since 2014, when we were 4% of the state's mortgage market. And about 47% of the first-time homebuyers we serve are households of color or from indigenous communities. We finance housing creation and preservation or rehabilitation. That helps increase the supply of affordable housing, both rental and homeownership, but also make sure that we preserve the housing that's there. So we did over 3,000 rental units. That was about 900 new construction, 1,700 of rehabilitation, and 295 units that were refinanced. Statewide, there were 7,215 multifamily new construction permits. Our numbers are about 12% of the production. So this is just a visual of that. Our Family Homeless Prevention and Assistance Program really helps do exactly that. Helps prevent families from becoming homeless, or for families who have fallen into homelessness, help them get rehoused as quickly as possible. And then we also have the Homework Starts with Home program. $51 million in 2025 served about 14,000 households. And the average amount of assistance per household was about $3,600. Those dollars actually go directly to whomever, whether it's the property management company or the utility company. The check gets cut directly to the entity to whom the funds are due. When you take a look at everything we do, from homelessness to rental housing to home ownership, there's a huge range of incomes of the Minnesotans that we help. And so this graph helps show that about 67% of the renters that we help have annual incomes that are less than $20,000. And about 35% of home buyers that we've helped have annual incomes of less than $65,000. But go all, up to $100,000. So there's a big range in there for the homeowners that we help. I know that geographic distribution is really important here. About 47% of all the assistance that we've put out since 2023 has, the money that we put out competitively through requests for proposal, 47% has gone to Greater Minnesota. And we pay very close attention to geographic distribution when we are making decisions about RFPs. It also very nicely aligns with the geographic distribution of households who are cost burdened. What's not included in the program assessment is the work we do at the end of every calendar year, which is our big consolidated RFPs for multifamily and single family. We call them the consolidated RFPs because we take multiple state and federal funding sources, and you only have to kind of apply to one RFP, and then we try to match the flavor of money to projects in order to fund as much as we can on both the single family side and the multifamily side. So in December, our board approved and we announced $166.4 million in state investments. That was funded 51 proposals, which includes 1,400 units of housing, 1,145 units are rental, and 279 are single-family homes. That 166 is a part of what's leveraged for $550 million in total development costs and supports an estimated 4,700 jobs around the state. That The dots on the map are the multifamily developments, and the shaded areas are the service areas for the single-family grantees who usually work within a geography. We have a few other major reports that we produce on an annual basis: the Affordable Housing Plan, the agency annual financial report, and then there are a bunch of other legislatively required reports. This is a list and the dates that they were due to you. One of the things that I just wanted to call out on this slide is that last session, you asked us to do a preservation framework for the targeted stabilization of regulated affordable housing. We did that very collaboratively with community and have gotten good feedback on it. And so just wanted to flag for those of you who have been following the kind of preservation conversation that you are in possession of that. And Chair Igo, that is what we prepared to summarize this report for you, give you a guide of what it is you have in front of you.
Thank you, Commissioner. We'll go to member questions. I don't know if anyone lists yet, but Representative Scraba.
Thank you. I don't know, page 4.
Slide
Sorry.
4?
Yeah, slide 4, sorry. The home buyer education counseling training, where do you find the people, where are those people from? Who are they?
Commissioner.
Chair, Representative, we contract with organizations that do it, so we don't do the training ourselves.
Right.
And so some of them are larger nonprofits, some of them are smaller, but they have a reach into communities of renters who, again, are kind of in an income position to start thinking about the possibility of buying a home. And so it's a network. And if you go out to mnhousing.gov, there's a list of all the organizations that we partner with on that. And it's an easy search tool for people to find somebody who does it in their service area.
Representative Scraba.
All right, thank you. Yeah, Chair, I've got a couple of questions. I'm just gonna, I don't want to ask, I'll ask them one at a time, if that's okay. On slide 5, 47% of first-time home buyers, we serve our households of color from indigenous communities. What are the average age of those folks?
Commissioner.
This is John Patterson. He's the person who puts the report together and my director of research and planning. And he says like 36, 37, 38.
Okay, so.
Representative Scraba.
And the reason I ask that is the average age is high like that, higher, and I didn't know if it was good, if it would change with different demographics, but it's on par for what the whole is. And also on slide 6, you have 2,361 manufactured home lots assisted and 1,420 single-family homes. Are some of them one and the same, or do you call them out like, are there manufactured homes that are single-family homes, or am I reading into this wrong?
Chair Representative, we do them through different funding mechanisms. The manufactured housing lot work is oftentimes infrastructure improvements. We've got a lot of old manufactured home communities around the state that have problems with sewer seepage, water quality, electrical, flood issues. So a lot of the investment is to have the infrastructure of those communities be restored so that the homes on the land, can be quality homes for the people who are there. Some of our single-family work could be modular or manufactured.
Yeah.
It's not all stick-built, but it's not double counting here. It's two separate activities.
So,
Representative Scraba.
yes, thank you for that clarification. Then like the manufactured home lots, like you say, you go into an area that's, can't use the word neglected, just not invested back into, and you go and help those folks, get them back up to speed. Even though there's single-family lots in there, that's not the same pot of money or same type of help as a single-family home. Yes, I understand it better, clear. Thank you. I think I do anyway. And I think that's it, but thank you. Thank you.
Thank you, Representative Scraba. Representative Meckland. Oh, I had you on my list. Vice Chair Dotseth.
Thank you, Chair Ego. Commissioner Holt. Question I've got is on slide 11, you've got that 166.4 million in state investment. Can you explain that a little bit more detail? Well, my mic's back on. Sorry about that. Can you explain slide 11 a little bit more in detail? That 166.4 million in state investments. I noticed that there were 1,145 rental units that were assisted. Can you kind of explain what we're doing for rental assistance as well?
Commissioner Howell.
Chair, thanks for forgiving me. I'm rusty. It's been a few months since I've been here. Chair and Representative Dotseth, so let's start with multifamily. The consolidated RFP is a combination of the allocation of the federal low-income housing tax credits. So if you're a multi-developer, you might get a 4% or a 9% tax credit. And then we have the challenge funding that you appropriate, housing infrastructure bonds, but there's been housing infrastructure appropriations as well. The preservation of affordable rental is a state appropriated one. We have money from HUD in the home program and the National Housing Trust Fund program. And then we also have bond financed bridge loans, and we do other mortgage financing. And then we also have some HUD Section 811 project-based rental assistance. So all those flavors of money get put out in the consolidated multifamily RFP. So when we select projects, and we're usually selecting at 1 in 3 or 1 out of 4 of the number of proposals we get because we just run out of resources, what we're really trying to do is understand the developer, the project type, and the eligible uses of those different funding streams. And so we'll fund approximately 20 multifamily projects in a year. And it'll be a mix of new construction and preservation. Some of the preservation deals are acquisition rehab preservation deals. Some of them are the same owner, and maybe it was a building that was financed with tax credits 35 years ago or something like that. And the building just needs some health and safety as well as just some quality of life investment. So on the single family side, so that's a range of for-profit and nonprofit developers and government housing redevelopment agencies or community development agencies that we fund in the multifamily space. On the single family side, again, it's challenge, it's housing infrastructure money, the new state housing tax credit and contribution fund. In 23, workforce and affordable home ownership, like all of those pots of money, same thing. We're trying to figure out what's coming in and how to best match the flavor of money to the specifics of the development. On the single family side, we do everything from helping community land trusts acquire land. Sometimes they're acquiring land that already has a home on it. Sometimes they're acquiring land on which to build a home. We fund a lot of Habitat for Humanity projects. We fund what we call value gap and affordability gap. Value gap is the difference between the cost of construction and the appraised value of a house at the time that it's complete. Because there are some places where the cost to build a home and its appraisal value, there's a differential from the get-go. Affordability gap is the difference between the purchase price of the home and what a home buyer can afford. So additional assistance to help somebody who's income qualified get into the home. So it's a wide range of activities. Some of our single-family projects are home repair. We historically have done a lot of ramps to help seniors stay in their homes. So it really is a pretty broad range of activities under single-family. And therefore, we're kind of just constantly trying to leverage the dollars that we have from you and from the feds to maximize. We do decision-making on the two consolidated RFPs for single-family and multifamily in roughly the same time frame, because some of the money you give us is multi-use, like housing infrastructure bonds and challenge. And so we're always trying to figure out, like, of everything that's available, how do we have, like, the right investments in multifamily, the right investments in single-family relative to what comes in. I think the biggest difference between decision-making on the multifamily side and on the single-family side is that you don't want me to fund a fifth of your multifamily apartment building, right? So when I fund one, we're trying to make sure that a project has their funding, I'll say mostly complete, so that they can actually get the deal done. On single family, we also use scaling. So you came in and said you wanted to do 20 homes. We say we can fund you for 5. And nobody says, no, thank you, we're only doing it if it's 20. A lot of what we do is we take a look at the completion of what single-family developers got from us in the past, like what percentage of what we funded in the past got done versus where is it that there's still money committed to that organization. And because we had such a large infusion of funds in 2023, in 2025, we had a lot of organizations that already had significant commitments that they hadn't yet completed construction on. And so we took that into account as we were thinking about what made sense to do in 2025. We use the term parked. We don't like to have a lot of money that's just parked and not moving out there. Obviously, we count houses one at a time. Multifamily adds up faster because we've got buildings that are bigger.
Vice Chair Dotseth.
Thank you, Chair Igo. Commissioner Ho, a follow-up question would be, it appears that there might be some redundancy in some of these different programs. Do you feel that there's more efficiency that we could take place to maybe consolidating some of these programs into one? I guess I'd like to get your feedback on that.
Commissioner.
Chair Igo and Representative Dotseth, I love that question. In 2023, the legislature created a lot of new line items in response to stakeholders who had a very specific interest, which ended up meaning that the agency had to stand up a lot of new programs, some of them which were only funded, at least for the time being, with one-time appropriations, some of which had purposes that could have fit under existing programs. I think I tried to respectfully advise the legislature that the money would move faster if it moved through our steady eddies, our core development programs, but it was just, 2023 was unique.
Vice Chair
Therefore,
Dotseth.
do I think that if there were an opportunity as the funds move through and those programs close out, for you to have a conversation with me or whoever follows me about, do we keep all of those active without funding in case there's further funding, or where would the efficiencies be? I know the agency would be happy to engage you in that conversation. I mean, for the time being, a lot of the new items have, 5-year grant periods, or they're construction programs. It'll take a while for them to move through. But we tripled the number of line items that we had in the 23 budget. All good things. All good things. But it just is a different way of thinking about it than just having some core development programs that are available for multiple purposes.
Vice Chair Dotseth.
That's it, thank you.
Next on my list is Representative Amani Hiltsley.
think you're going to get mic coaching.
Thank you. Can you hear me now?
Yeah, it's
All right,
better.
I can hear myself too.
Better.
Much better. Yes, going back to my question, I know last year there was this number of 100,000 units needed. And I'm just curious, can you guys talk about that? Because when I'm looking at slide number 7, it looks like 900 newly constructed units were constructed. And I'm just curious, can you tell me more about that number? Or was it just that number that we just came up with and we're rolling with? I'm just curious to know.
Yeah, we have a lot.
Commissioner.
Sorry.
Yeah.
Chair Igo, Representative. We have a serious housing shortage in the state,
Right.
and I think people estimate it slightly differently, but the answer is it's a big number. And law of supply and demand, when there's more demand than there is supply, it creates an affordability challenge in terms of pricing, and I think we're seeing that. We're seeing the impact that that has had on inflation. We're seeing the impact that has on families. We see the impact that has on people's ability to buy a new home. And so, you know, the agency's financing only represents a small portion of all housing creation in the state. But what you invest in is really important because you're investing in the housing futures of lower income Minnesotans who are less likely to be able to weather what's happening in that rental and home for purchase market writ large.
Representative Romani Hiltz, any follow-up? Okay. Next on my list will be Vice Chair Kozlowski.
Thank you, Chair Igo, and got my microphone on. Commissioner Ho, thank you for being here, and of course, I am the first one to say I'm very grateful to see you at the Capitol and the work that you're doing, as reflected here and out in community, because it means that when I get to see you out in community, that we're bringing new units online, or we're cutting ribbons and getting to work to bring them to fruition. I think one of the biggest things on my mind, on many Minnesotans' minds right now, is that rent is due in 5 days again, and with this all-time high evictions from 2025, January we started the year with 2,200 evictions filed in Minnesota. We have unfortunately done a lot of really tremendous work in Minnesota, and that has been deflated and brought down by a federal government that is working against us with ISIS terror that is still in our states. And immigrants, people of color, Native folks, as we heard last week, are already struggling to pay the rent. And I'm wondering, in terms of your perspective from Minnesota Housing, what are you thinking in terms of bringing forward a proposal that answers the calls in Minnesotans that have been doing peer-to-peer crowdsourcing and funding to prevent evictions? From your agency perspective, what are you seeing in terms of trends and data, but also in terms of a response that matches what Minnesotans are stepping up to do?
Commissioner.
Chair, Vice Chair, we're in conversation with the governor's office and MMB. We're in dialogue with advocates that are looking for emergency relief or more family homeless prevention dollars. I can't get ahead of the governor's supplemental budget decision-making, which will happen after the February forecast, but we certainly have been in close conversation with the governor's office about the level of need that's out there, but also reminding folks that the Family Homeless Prevention and Assistance Program is always less than what is needed for renters who are behind. There are times where that program is only helping 1 out of 10 households who needs it, and the organizations that manage the funds have to make some really difficult decisions about who they prioritize for assistance. And so, we have never been in a situation, even when we were moving $500 million of federal COVID-related emergency rental assistance, where we felt like we were helping every single household who needed it. But I look forward to the conversation around, whether we can bring, more funding to the table. I just can't get ahead of my boss, or I don't get to sit here.
Vice Chair Kozlowski.
Thank you, Chair and Commissioner Ho. I appreciate that, and I understand you're in a tough spot. I think as leaders and holding the positions that we're in, we've all seen that the Commissioner of Deed brought forward a $10 million proposal to help the small businesses that are really suffering. Of course, the small business and bringing in wages goes hand in hand with rental assistance and being able to stay in your house. And I guess I'll just follow up by saying, like, have you looked under the hood of the agency to look where there are unencumbered dollars or dollars that we could put towards rapidly deploying towards rental assistance and things within the lever and the wheelhouse that you have to be able to make sure to get that needed relief out to Minnesotans?
Commissioner.
Chair, Vice Chair, we have been in dialogue with our family homeless prevention and assistance partners. We have given the organizations that touch the money permission to spend faster than what they have or would do if they were kind of meeting it out quarterly on a regular basis, but understanding that there's no guarantee that we will get more money here. So if you spend the rest of the biennium's money now, it does create a problem later. But instead of making that decision at the agency, we're empowering organizations to make that decision for themselves and based on who they're serving and what they're seeing as need. We have been in conversation about what our experience was when you did a fast track of additional money into that program in the past. And for government to find fast, like what's the fastest way for us to expand the program where more funds appropriated? And so we're really trying to figure out what is it within our power to do, and if there were to be more money here, what's the ways in which we could get it into the hands of our administrators as quickly as possible?
Any follow-up? All right, we'll go to Co-Chair Howard.
Thank you, Commissioner. Always good to see you in Housing Committee. First, a comment. You mentioned this is a presentation with lots of numbers, but behind those numbers are huge impacts, life-changing impacts for Minnesotans. And what we see, and like you presented, from preventing homelessness up to home ownership, real life-changing investments being implemented over the last year. So thanks for your work to do so. My question was related to impact or matching need, rather, with the impact we can have with our dollars and what those gaps look like. And you've kind of hinted at this. The two areas I'd be curious your comments. One is rental assistance. I know that the agency does an annual assessment of need to assess, what if we're looking at the total need for families experiencing a housing crisis that need emergency rental assistance, what would that resource look like to meet that need? I'm curious if you have that at the ready, or a just an estimate of what the need is across the state versus what we're deploying, and of course that's not contemplating Operation Metro Surge. And then same question in terms of your RFPs for your consolidated RFP. I know I've heard many presentations over the years when I feel like for many years it was 1 in 4. It was, for every, 4 really quality applications to build new homes that are ready to go, ready to get funded, you'd only have the resources to fund 1. I'm curious over the last year if that's similar in like the 1 to 4 or what that looks like. So those are my 2 questions.
Commissioner.
Chair and co-chair, I think looking at the number of cost burden renter households is probably a good way to think about need. The best way to solve for the cost burden would be rental assistance for folks that are cost burdened. And of course, it's a win-win, because if that also means that the property owner is more likely to get paid on time. I think that that's probably a good proxy for that. I do believe this year on multifamily we funded 1 in 3 projects that came in, but we didn't fund a lot more projects. I think the development community watches what happens up here, and when there were a ton of resources available after the 23 session, we got more proposals, which doesn't help us with our batting average on what percentage we're funding when we get a lot more proposals, even if we had a lot more money. So I mean, I'll say this. Most of the proposals that we get in, I would love to fund. And so, you know, the opportunity to say yes to more is great. This is a bonding year, housing infrastructure bonds. We were just presenting over in the Senate. We've passed now 10,000 units that have been invested in with housing infrastructure bonds, and like a total, like, fully leveraged development cost of over $2 billion since the housing infrastructure bond was created in 2012. You know, that and the appropriated development tools, you know, challenges the workhorse. A challenge because it can fund a lot of different things, so it allows communities to identify what they need, and we've got a funding source that's flexible to work across single family and multifamily, do preservation and new construction. So, you know, we can always put more money to work.
Co-Chair Howard.
Thank you, and that's helpful. Especially on the production side, it highlights, you know, these are, but for these public investments, we would not be able to leverage all these other resources to build these homes, and so it's been great to see these large numbers, and, you know, try to see this pipeline continue to move forward. Which, one follow-up question, you mentioned housing infrastructure bonds. I'm wondering if you would comment on the administration's desire to see us utilize housing infrastructure bonds this session to help that pipeline move forward. I understand that housing infrastructure bonds are part of the governor's proposal. You know, do you see housing infrastructure bonds this session as a way to sort of continue to keep that forward momentum and avoid kind of a backlog situation?
Commissioner.
Chair and Vice Chair, I am hopeful that we'll have a bonding bill this session and that housing infrastructure bonds will be in there. The governor's capital investment proposal includes $50 million for housing infrastructure bonds, and I'll just toss in $10 million for public housing preservation as well. I believe that the advocacy community is going to be talking about $200 million in housing infrastructure bonds. That has been, I think, the high watermark of housing infrastructure bond investment. And you know, we've always told the advocates it doesn't bother us when you ask for more than we do. We know that money can get put to work. So you know, we'll be in capital investment this week yet, and looking forward to continuing to talk about that, and kind of hoping that capital investment and the bonding bill just include the housing infrastructure bonds. That would be, I think that would be great and take some pressure off of this committee if we were able to do that.
Any follow-up? Representative Mecklin.
Thank you, Mr. Chair. Thank you for joining us, Commissioner Ho. I have a couple things I want to ask. In the process of how you do this, particularly as you mentioned earlier, the manufactured home sites and the infrastructure underneath, or in the new construction or refurbish, what is the time frame from application to groundbreaking, from groundbreaking to the CO? Move-in ready, if you will.
Commissioner.
Chair and Representative, it depends. I mean, it's very, very different from project to project. I think how shovel-ready is the project when it comes to us? Is it funded by us in a way that completes all the financing that's needed? And so there's not a regular, I guess I'll say, there's not a regular. We do have a manufactured housing community team now. We didn't have that when I started in 2019. And, they're able to go out and assist people who receive our funds. And, sometimes it requires sign-offs by a city or other entity. So there's just, especially since the manufactured housing community work is newish for us, we're kind of learning alongside the owners. Some of these are cooperative conversions. So they were privately owned and the private owner is selling to the residents themselves. So they're having to figure out all the governance and ownership transfer associated with that. Sometimes it's just the owner who's, ready to get a contractor and fix the seeping sewage. So sometimes it's lot preparedness. It's a lot that for some reason couldn't hold a home anymore, and so it's getting a lot ready for a new home. Sometimes it is existing lots beneath existing homes. So it's just, we're still learning, and I don't feel like it's at all, there are 3 ways that this works, and this takes this long, and this takes this long, and this takes this long, because I think the property owners are also learning how to work. They're not used to having the state as partner.
Representative Mecklen.
Mr. Chair, thank you. Okay, let's just go from application to approval from that aspect. What is the time frame within the agency that, in these types of projects, what does that kind of time frame look like?
Commissioner.
Chair and Representative, let me walk you through the multifamily one, because that's the one that's the most top of mind and easiest for me to kind of recall. Every year, we put out an application in, I want to say April-ish.
Okay.
They're due in July-ish. We review and score. The agency makes recommendations that we bring to our board at the final meeting of the year, which is in December. The board-approved folks find out they've got it. Then they've got to figure out how to organize the closing of their financing on the construction project, whether it's new construction or a rehab project. Sometimes we're the first commitment of funds, and what we commit, there's still a gap. Sometimes we're the last commitment of funds. Sometimes the price of construction goes up between the time we make the award and when they're ready to close, so there's another gap that's identified. I think of the ribbon cuttings that I attended in the legislative off-season, the shortest timeline was probably a 2024 award, and the longest timeline was probably 5 years old.
Well,
Representative Mecklen.
thank you, Mr. Chair. Little off topic, but something else that you mentioned, I'm glad Rip Norris has come to the committee, that we are seeing within the manufactured homes, and I believe Rep. Norris has a bill about this topic, but there seems to be a new set of conundrums for a lot of these owners if their parks are getting sold out. And we're also seeing in a lot of large neighborhoods that when they have a, say, like a shared septic system, and it's maybe feeding 200 homes, that there's nowhere for them to go to find any type of financing, and perhaps we could have a conversation offline to try to, I don't know, find something for these people. I mean, these assessments are, I have 5 of them in my district on the septic side, and they range from 21 or 22 to 29,000. They were only given 3 years to make the payments. And many of them are significantly suffering, but there's literally nothing there, county, city, state, anything. So I think that's a big thing we should be looking at. Thank you, Mr. Chair.
Any follow-up to that, Commissioner?
No, Chair, I appreciate the comments. I feel like I've gotten an education of a lifetime on manufactured home communities. I don't drive through Minnesota the same way that I used to, because I see them all now in a way that I just really didn't before. And then being able to go out to some of these communities and celebrate the cooperative conversions and just kind of see the whole huge range of conditions of homes on these lots, as well as the lots themselves. It's been an extraordinary education for me and to meet the residents of these communities.
Thank you. Well, seeing no further questions, I just have a few follow-up to close out all this. And I guess I want to start, and it looks like you have the slide up, so it'd be page 3. I really want to zone in on that 191,000 number. And what I wanted to ask, and it's going to be a number deep dive, so if we have to follow up, that's totally okay, but I wanted to ask. When you're looking at that age range of 25 to 44, and we've deemed that they're potentially income ready to buy a home, what is the barrier keeping them from being able to buy a home?
Thank you, Chair, for the question. It's having the cash for the down payment assistance. So oftentimes it's, I have to say, some folks don't have the bank of mom and dad, or they just don't have the savings. So it is a large barrier to entry. The agency has down payment assistance. We ran the first generation down payment assistance that you gave us money for in 2023. MMCDC, Midwest Minnesota Community Development Corporation, is, I think, still managing first generation. I mean, we know that when we can offer cash to close, that people who are able to sustain the mortgage because of their income are able to get into homeownership. And I think just the price of homes, we were just talking over in the Senate, in the 1960s, the average age of a home buyer was 23, and the average price of a home was $22,000. I mean, the fact that the average age of a home buyer now is 37 or 38, but the average price of a home is exponentially bigger than $22,000. A down payment today can be more than what the price of a whole home would have been back then.
Well, and thank you, Commissioner, for that response, because that's what I was kind of getting at as well, right? Besides the down payment assistance, it's the median home price in the state of Minnesota, right? So it's working on making sure we have adequate home stock, because as we increase supply, we're going to drive those costs down. And then, yes, down payment assistance is helpful, but if the price of homes comes down, that gives people, especially this 191,000 people in our state, hopefully the opportunity to pursue home ownership sooner rather than later. I also wanted to kind of follow up, and it's been a conversation that I think is going to happen a lot around the legislature around fraud. I want to give credit where credit's due. Minnesota Housing Finance, you guys have done a good job. My question for you is, can you give this committee a presentation and just kind of a download, I guess, on some of the measures you do to make sure that when you get state dollars or you lend dollars, you're doing it in a way that's making sure to keep the Minnesota taxpayer in mind and make sure that we're building homes and supporting communities?
Thank you for the question, Chair Igo. Obviously, we've been a part of many conversations around the fraud challenges of the state. I mean, the largest line item of what we do is single-family mortgages. It is a highly regulated industry that just is not ripe for fraud. And so I think just the regulatory nature of, I mean, that's a billion of what we move. It's the bread and butter of what we do as an agency. When we're investing in a construction deal, whether that's new construction or rehab, I've got architects that go out and they're on site. I cut ribbons. I've never been to a ribbon cutting where a building wasn't there. And so, there's that. We manage a large pot of HUD project-based rental assistance. That is rental assistance tied to, actual fixed units. And we have a whole compliance team that's there to make sure that the people who are in those units meet the income requirements and things like that. We don't operate, the breadth of direct assistance programs that some of our sister agencies do. The agency that in my tenure, where we have had very limited cases of fraud, has been in the direct assistance of family homeless prevention, but it's what I would call old school fraud, where you have a legitimate organization that's legitimately providing support to people who meet the eligibility requirements, and maybe you have one employee who figures out how to falsify a person or two. Just take a little off the top, But I think in my tenure, one, we have a mechanism for being repaid in cases where there was improper payments. But oftentimes it's our partners, whether that's county government or nonprofits, who identify the problem, bring it to our attention. We do all the appropriate reporting, and then there will be some type of, a follow-up, and if indeed fraud was found, like I said, a repayment to us is necessary. So I would say that being in the construction and, production and rehab business, like, the buildings are real. And that's the vast majority of that, and loans, it's the vast majority of what we do.
Thank you, Commissioner, and I appreciate the response, and I understand, like you said, you are a little different than your other sister agencies, but some of the things you outlined there are things that could be implemented in other parts of our state government. And so I appreciate that, and I'll probably follow up with you for some of those things, because I think we can learn from each other so that the state can do a better job of managing our tax dollars. So again, thank you to you and your agency for doing a good job like you have. So Representative Scrabo, quick follow-up.
You described the knuckle breakers. We have someone follow up to make sure they pay. Do you do that, or do you have an outside agency? Just the way you described it, I kept picturing, waiting for you to say, Guido's gonna go get him, who does that? Because that happens in the real world. They just don't want to pay, they don't pay, they walk away. So who goes back to get them? Do you, or do you have another organization? Thank you. Sorry.
Commissioner, who goes back?
Chair, I want to reassure you, I've never broken anybody's knuckles. We contract with nonprofits or government, and so they have the responsibility for this. Fraud isn't usually about a real family that committed fraud and we're trying to get money back from them. It's about somebody who's in the middle who's doing it. So the prosecutorial work and the accountability work is between the agency and the fraudster. The payback is between the nonprofit or county government and us. And I've never had somebody say, because they want to keep doing business with us. No, nobody's going to say, yeah, one of our employees committed fraud, we found it, and we're not going to pay you back. It just doesn't happen. And like I said, it's been a very, very limited number of cases. I inherited one. There's been one during my tenure. There's been one where we've investigated suspicion, but haven't proved fraud.
Well, thank you again, Commissioner, and your entire team for being here today. And this is good to see where things are at and continue doing great work. And thank you for the collaboration you have with this committee in the state of Minnesota.
I want to thank you and the whole committee for just the enthusiastic support for the idea that we need more housing in the state. Thank you.
Thank you. All right, next on our agenda, we're going to have the Minnesota Realtors with us today. So if Mr. Egger and Mr. Arbit want to make their way to the front and then get settled, and when you're ready, just introduce yourself for the record.
Mr. Chairman, members of the committee, my name is Paul Egger, and I'm Senior Vice President of Governmental Affairs for the Minnesota Realtors Association. Thank you so much for the invitation today to do a very deep dive into some of the market data that you started to touch on with the commissioner a minute ago. We're really pleased to get the invitation again. We take the role that our organization plays for our members in collecting and disseminating data seriously, and we're so pleased that you are taking time today to invite us back to have the discussion with the committee. I'm going to turn it over to my colleague, David Arbit, who has a very robust set of data for you. He's going to move very quickly through some of the slides, but you'll have this information in the handouts, and we're always happy to come back and visit with you either in committee or individually if you'd like to go into any of the information that we either share today or we have to gloss over due to time. So with that, Mr. Chair, I'll turn it over to David.
Thank you, Paul. Mr. Chair, members of the committee, an honor to be here. Just want to echo Paul. Really an honor to be back. Thanks for having us. And an ambitious amount of slides to run through with you all today. So I'll make sure we cover it or as much as we can. You know, our data is really rooted in the MLS. So it's multiple listing service data. We use a lot of different metrics to sort of measure what's happening with sellers, buyers, prices, housing supply, negotiations, market times. And that's kind of what you all will see here. So I won't go through every one, but I'll go through four. One is there's confusion about new listings versus active listings. A new listing is a home that went on this month. An active listing is a home that's active this month, but could have been listed at any time. Late last year, January. So just a couple differences there. They both kind of reflect supply, but different measures of supply. And then the other one that there's sometimes confusion on is pending sales versus closed sales. Pending sale, simply a signed contract, an executed purchase agreement. It hasn't yet closed. So just a couple things to be aware of there. I think you all have the rest, so feel free to kind of browse through them. Most are fairly intuitive. Days on market, how many days a home takes to get an offer, inventory, number of homes on the market. And away we go. So this shows statewide activity from last year compared to metro activity. It's always useful to kind of benchmark, you know, different regions or the metro against the state. Again, I won't go through all of these, but maybe I'll just point out a couple interesting insights. You know, new listings up about the same, you know, 4.5% to 4%, you know, state versus metro. Closed sales pretty similar, 2.3, 2.4. Inventory was a little bit different, a little bit more inventory growth in greater Minnesota, perhaps where there's fewer hurdles and barriers to build and develop homes and more land available. And then you can see prices both up, 2.5% to about 3%. You can see market times, home selling a little bit more quickly in the metro. And then one of our favorites, month supply, and we'll be talking about this a couple times. A little bit of a tighter market in the metro at 1.9 months compared to statewide at 2.2. We're shooting for about 4.5 or 5 months of supply. So we're still way under despite a 25% decline in sales because of higher rates. Another one of our favorites, this is a long-term view. Forgive me, this is just metro. We only have metro data going back this far. We don't quite have statewide. And what we're doing here is just comparing, you know, what's going on with sellers to what is going on with buyers. And so anytime you see supply sort of get away from demand, that's when you typically see home prices soften. And so we kind of saw that here. We saw that during the Great Recession and the housing crisis. But, you know, we could kind of talk about this for a while, but the other takeaway is look at how activity has come down, but they've come down together. Both seller and buyer activity have come down together, and that's kept the market pretty tight. That's kept things pretty tight. So activity kind of comes down, but it's still really tight. We see a little bit of a jump in new listings, which is encouraging. Although sales, while they showed a much smaller gain, just because first-time buyers, rates, prices, and everything else, and the cost of everything. So that was new listings and sales. This is just price, the median home price over time. Pretty apparent to see our housing bubble there and then into our crash. And then we can see just how prices have moved since then. One of the interesting things that we threw on this is this sort of range, and it's kind of these two dotted lines. And if you were growing at, 5.5% each year, you'd be dead in the middle of those two lines in that range. And so you can see we were a little bit over our skis and then a little bit under. And the other thing you'll notice now is we actually just kind of kissed the bottom end of that channel. So, you know, some claims of a bubble or that things are way ahead of themselves. This doesn't necessarily prove that, but that could be the case in some different areas. So just a few thoughts there. A question we get a lot from members, from the media, from the public, are people still married to their interest rates? Or at least in a committed relationship. Some are, but it's changing. So I want to talk about that just for a minute. So this shows mortgage applications, that sort of blue mountain range, compared to the 30-year fixed mortgage rate, so the cost of borrowing money to buy a home. What's the nature of this relationship? It's inverse, of course. It's what you'd expect. So as rates go down, you see mortgage applications go up. As we've seen the high rate environment we've been in, you can see the impact on applications and people looking to kind of get moving on pre-approvals. We are encouraged by, rates continuing to hopefully turn a corner, which should mean more applications, more showings, more pendings, but then begs the question, do we have the supply to fuel that demand if rates do continue to trend downwards? So that's always a question on our minds. So married to your interest rate, look at the share of homeowners with 6% or higher rates compared to those with 3% or lower rates. And this is really what's been locking up the gears. This is what's been rusting the gears together so that the market isn't moving, isn't churning like it should. So if you look at blue, that's a lot of people who are financed below 3%. In red, people financed above 6%. And you can see kind of when it happened during the pandemic, 2020, when the Fed cut rates. And what's happening now? I think this is really important. We're finally kind of crossing, which means the people who are in 6% rates, 6% or higher rates, are a lot less locked in. Because were they to move, their rate would be flat at about 6 or whatever it is. I think we saw 5.99 yesterday, which is encouraging if we can stay there. So I really think this is an important way to think about how the market is sort of unlocking and starting to move a little bit better. So Market Watch from when? A month and a half ago or so. So for the first time in years, more homeowners have a 6% mortgage rate than a 3% one. Good news for frustrated buyers who have been frustrated on the sidelines. Okay, the race is on, listings and sales. So these are our kind of big historic charts. We go all the way back to 2005. Some have asked, do we need to go back that far? I think yes, because it shows different market cycles. And it's also useful to say, when's the last time we were this high, this low, at this level, so on and so forth. I won't spend too much time on these, but you can see when activity really pulled back into the Great Recession, we stabilized a little bit, and then you can see when everyone was married to their interest rate, when they were not moving, they weren't listing their homes, and then we're finally seeing some movement on that. However, we're at a 3-year high, and we're still below 2022 levels, so looking for some movement there. By the way, this includes single-family townhomes, condos, existing and new construction, but not all of it. I'm looking to my friends at Housing First. We can't capture all of new construction if it's not listed in the MLS, but it does a pretty good job of sort of showing what's happening. Closed sales, not quite as much of that recovery as you've seen in new listings. And you really can see that the COVID boom, or the buying frenzy that some people call it. And then you can see activity come down just because of the affordability challenges or crisis that we've been in. How long are homes spending on the market? About 44, 45 days. That is a 5-year high. And yet, homes are still selling more quickly than they did in 2020. Both can be true at the same time. The internet and a lot of things have helped homes move more quickly. A lot of apps, a lot of different portals and whatnot. So, homes are taking a little bit longer to sell, but they're still selling faster or in less time than they did in 2020. Median price, this is the big one that people seem to like and watch, ourselves included. And you can see that 2.9% gain, so about a 3% gain. Maybe I can zoom in a little bit. You see about that 3% gain, which was fairly close to the rate of inflation, which means real prices were flat. We won't get too far into that. But you can see those 9% and the 11% gains during COVID, when the supply-demand balance was even more out of whack than it is now. So it's nice that price growth has sort of settled into what you might think of as an average range, but incomes have to keep up and rates have to cooperate. Another one that we like, I hope I'm not saying that about all of these slides. Another good way to measure negotiation, so who's got the power, buyers or sellers? Who's holding the wheel or the reins? Well, up here, sellers were able to get, let's zoom in again, sellers were able to get 100.9%, so that's 101% of their list price, so that's over 100%. So all of their list price plus 1%, a lot of multiple offer situations, a lot of this kind of competitive bidding war type of dynamics. And then most recently we saw this pretty flat at 97.8%, which you'll notice is still above some of these pre-COVID years. Inventory, this tends to be a popular one as well. How many homes are there listed that are under active status? They're actively marketed today. You could write an offer on them this afternoon, and they are under active status. So we squeezed out a small win, but a win, 3% more inventory. Has to do with the fact that sellers are having a little bit of an easier time if they have equity as a move-up buyer or a downsizing boomer or any downsizer. And so you see a little bit more inventory growth, which is encouraging. But you'll also notice at 13,000, look back at 2019. We are still, we've got a decent room to run until we get back to pre-COVID inventory levels. So still sort of suffering from that shortage that was caused by rates really lowering and all that demand we saw scooping up all the inventory. Month supply, kind of hinted at this earlier. We're looking for, I think I've even got a balanced rectangle. There we go. So we're shooting for this balanced kind of box, and you'll notice we are not there. We are still well below it. Again, despite 2025 30% decline in sales. It depends on where you look, and if you're looking at December, January, or annual. So 2.2 months of supply, still a seller's market, but a much looser market than when we had 1.2 or 1 months of supply sort of at the height of COVID. So a couple things to think about there. We really like this metric, so I think it's worth just kind of diving into it a little bit and talking about what it means. A seller's market. Look, you've got a lot of buyers. They're all competing over one unit of supply, right? So these guys are all trying to outbid one another to win this seller's, to win this home. In a buyer's market, you've got more supply relative to demand, which means instead of these buyers competing with one another, it's really the sellers that have to make some concessions, maybe do some repairs based on inspection, maybe a rate buy down or something, home warranties, some sort of incentive in that market. And all we're striving for is a balanced, healthy, balanced market with a balance between supply and demand that has proven elusive for many reasons. So sticking on inventory, there's been a couple different figures thrown around about how many homes do we need. I think Commissioner had some good figures. Some look at multifamily, some just look at single family, some look at single family townhomes and condos, some look at what it would take for everyone over the age of 18 to own a home. What we look at is what would it take to get to a healthy balanced market of five months of supply. So that's kind of our methodology, if you will. And what we've come up with is we need about 19,500, about 20,000 homes. So we'll hear 5, 10, I've even heard 100,000, 200,000, 300,000. What we find on the owner-occupied side is about 20,000. But that need varies greatly by price point, right? The need varies greatly by price point. In fact, as you get up into $1 million plus, we could actually shed some inventory and still have a balanced market. You can see where most of the demand is. And the cool thing about this one is you've got current inventory in gray, you've got how many new units you'd need in blue to get to the total in green. So sort of it measures three things in one happy little chart. That's statewide. I've also done metro for districts in the metro. And you know, not a huge difference here, but the numbers are different, but the trend is kind of the same. On a percentage basis, how many, what's the percentage of units we'd need to get to that balanced market? You're looking at that right. We need over 125% more. So we need to more than double just to get to a balanced market in that 300,000 to 400,000 range, which is where the median price point is. We're about 340, 350, 360, metro closer to 400. And so these are this is the growth in units needed to achieve that balanced market, or what an economist would call market equilibrium. Okay, so that's what we need. Let's see kind of how last year behaved. So change in new listings by price range, 2024 compared to 2025. Let's just start with that first time kind of entry level, most affordable bracket, down 1.5%, 2%. Not a lot of supply. Those folks are kind of hanging on to their homes. There just aren't that many of them anymore. And what would have been in that range a few years ago has appreciated up out of it. And then you see, you know, the best performance is among the population who's the least rate sensitive. And that's kind of, you see that on the higher end. So that's where the market's more balanced and people are able to, that market, you're seeing that price range churn a little bit more. Sales, pending sales, pretty similar story. You see the pullback in the first-time buyer brackets and the most affordable brackets. Strongest growth up in the luxury bracket, and you can kind of see overall how that looked. Don't discount the growth here. This is from move-up buyers. I think this is actually pretty interesting. This is from buyers selling their $350, buying $550, and they have equity from the first one. So it's easier to roll that into the next one. You sell your home, you bought it for $250, you sell it for $350, you take that $100K, that's 20% down on the $500K home on the next one. It's the first-time buyers, as you'll see, that are really struggling to break into the market. Our Housing Affordability Index, another good one. Don't overthink this. It's easy to overthink. Sometimes I fall prey to that. What you need to know is higher numbers, better affordability. Lower numbers means affordability is much more challenged, much more pressure. You can see when prices fell and in the housing crisis, you can see really high levels of affordability, low rates, low prices. Now, what do we see more recently? Just the opposite, but we're seeing a little bit of an upturn, which is encouraging. This number 95 tells us the median income is 95% of the minimum income that you need to qualify for the median priced home. I know that's a little wonky. That's why we say higher numbers, better affordability, lower numbers, worse affordability. But the other takeaway is that the median income is 5% below the minimum income needed to qualify for just the median priced home. So sort of an interesting stat there. I think we covered that one. Let's skip that one. Yeah, a little bit of a Goldilocks zone here where you see market times, kind of that sweet spot in that 300,000 to 400,000 range where market times are more like 37. So I know we look at 45 or 50, but just know that each price range and each area really is unique, and we'll talk more about that as well. I wish I had a happier slide for you. We're not here to make you guys happy. We're here to kind of tell you the truth and share what's happening. This is what's happened with payments. Sometimes we talk about, today's consumer is less price sensitive, but very payment sensitive. Do they care if price went up 5%, if their payments came down? They don't really care. So, it's not that prices don't matter. We track them, we follow them, they matter. But today's consumers are very payment sensitive. And so that's why we track this. So if you'll notice, over what, 1, 2, 3, 4, 4 or 5 years, the typical payment on the median priced home has risen $1,000 per month. My math tells me that's about $12,000 a year. The median income isn't that far away from 120, 125, which is a pretty significant share of your typical Minnesotans' income.
Mr. Chairman, just to note, this is your all-in payments. This is your PITI, your all-in payment per month.
Yep, this is everything. Using a couple assumptions like 10% down instead of 20, but also not 3. So we're kind of trying to be somewhere in the middle with some assumptions around insurance and taxes, which I think we'll talk about shortly. So that was statewide, about $2,600 per month. This is Metro, more like $2,850 per month. Maybe that's more of a difference or less of a difference than you'd expect, but it's nice to sort of display it at both levels. Okay, well, that's well and good, but what's happening with income? So that's the payment, but out of what share of the pie? That's the slice of the pie, but how big is the pie? Well, those payments are taking up about 27% of pre-tax income. The rule here is 30% is typically considered housing burdened, where you're housing burdened. And what we see is, about 26.5%. We're encouraged by the fact that that's down from 27 1/3. And this is pretty fascinating too. You can look at that 06 level when kind of at the peak of the housing bubble there. And so nice to see us kind of turn a corner. We're looking for this trend to continue. Everything's relative, so let's benchmark that against the nation, where nationally it's much closer to 30%. So we're a little bit better. We'd like to be even better. But nationally, your typical family spending about 30% of pre-tax, little under 30% of pre-tax on housing. So there's no magic bullet. I think we know that. However, there are some factors that can help address some of the challenges that we see in the market. I'll just kind of rattle off 4 of them briefly. 1, prices decline or flatten. Maybe not the happiest outcome for current owners, but if they flatten and give incomes kind of a chance to catch up, maybe that's okay. And that actually is kind of what we're starting to see. Speaking of that, number 2, incomes rising faster than prices. We are seeing that. You know, I'll skip down to number 4. Rates come down. We have seen that. We talked about kind of seeing that 5.9, 5.99. But 3, I really want to emphasize 3. Sometimes we say that's where we have the levers. That's where we can have some dials and some knobs and levers to turn and pull in terms of tax, regulation, incentive, getting more homes built. That's where I think we have control. And that is a market-oriented solution that prepares us for future growth, future population growth, so on and so forth. So that's the one that we really focus on and think the most about. All right, these next 3 will also not be the happiest slides you'll see today. But this is national, by the way. We're actually starting to do this for the state, but this is national. This is the percentage of first-time buyers. So out of 100 buyers, here, 50 of them were first-time buyers. Out of 100 buyers last year, only 21 of them could be first-time buyers, or I should say were first-time buyers. So this is really a challenge. This is not what we'd like to see. I don't think this is what's good for the state or nation. And you can see the decline and kind of just how far below it is from that average. During the Great Recession, when home prices went on sale, you can kind of see the pattern there. They say most people age 12 months each year. Since I had twins, I get 18 months older every single year. So 40. The typical first-time buyer age is 40. That's the median. Half of first-time buyers are older, half of first-time buyers are younger. And you can see the trend, and here the trend is not our friend. And so, you know, we used to be 32, 30, 31, and then all of a sudden, it became 40. Really reflects the affordability challenges and everything else that we've seen. Last one of the sort of difficult ones to see, actually there may be some others, but seller tenure. So this also kind of highlights or visualizes just how much people have felt locked into those mortgage rates. People used to move every 5 to 7 years, 6, right in the middle of that range. After the Great Recession, we started staying in our homes more like 10 years. And then during COVID, when we could move to the cabin or move to the Sun Belt or work remote from anywhere, you see more movement, more churn there. And now again, as people are feeling more locked in, and some of the uncertainty and other factors, you see people staying even longer. If you've ever heard, I think all of us have heard a story, someone's still stuck in their first time home. They're married to their rate, feeling kind of stuck in that first home. All right, we'll fly through a couple of these. These are interesting, but maybe not as interesting as some of the others. So we get asked by the media, by the public, by members, you know, how much single family do we have versus condo? Some markets are 50-50, some are 75-25. We're about 80% single family versus 20% townhomes or condos. And you can see that change after the Great Recession. You know, something to think about here is that this segment of the market has its own challenges around insurance and HOAs and plenty of other things on that list, but it offers a density, which is a way to sort of have more units per acre. And I know density is kind of a dirty word sometimes, but if we want to have more homes for more people without growing all the way into Wisconsin or Iowa, then we should think about density. New construction, talked about this one, again, deferring to our friends at Housing First who just have better data on this. But in the MLS, about 8-9%, last few years closer to 10% of all sales are new builds. And you can see this trend from kind of the bubble into the recession, and then some nice recovery. But our builders are facing, you know, a lot of challenges, starting to feel better, but, you know, looking for new opportunities to build homes. Yeah, bigger homes. You can see that 25% of our sales are 2,500 square feet or bigger. You can see the condo activity here, which is always kind of interesting to see that show up. You can also see kind of after COVID, 2021, I guess during, you see that increase, people wanting the 5th bedroom, the 3rd, you know, home office, home classroom, people kind of needing a little bit more space. So you see the impact, you can sort of see the impact of that there. We're getting asked about this. Lender mediated, are we seeing foreclosures or short sales? And the answer is not really. The answer is not really. At least they're not hitting the MLS. And so there was a time when 45% of our sales were either foreclosures or short sales. a scary time. But you can see how much that's come down. You can also kind of see that there was a moratorium there, so you see that was kind of skewed lower. But over the last 3 years, we've been really stable between, around 1.25%, 1.33%. So we're watching this closely, being asked by the media, by members, by others, what's going on here, and I show them this, and not a ton, at least not yet, and we're not really forecasting any kind of, crazy change here, but we are watching it. Yes, the idea of regionalism. So far we've been talking mostly state, some metro. The truth is, there is no state housing market, right? It's just an agglomeration or an amalgamation of local housing markets. There is no national housing market. You wouldn't grab an umbrella in Miami based on the weather in Seattle, we like to say. So all housing markets truly are local, and I want to just highlight, something there as well. So when we ask how deep is the mud, it really depends on who you ask. Thanks for that. Here are a few different regions across our beautiful state, So we've got Alexandria, Brainerd, Grand Rapids, skipping down Hibbing, Virginia, up on the Iron Range, Duluth, North Shore, our friends in St. Cloud, the very hot market down in Rochester, and then we've got 7-county, 16-county metro, and then again, kind of all benchmarked against the state. We will not have time to go through all of these as much as I'd love to, so just kind of breezing through. I think the big takeaway is this last line. So look at month supply. You'll see every single region of our state is undersupplied. Everybody has less than 5 months, everyone has under 5 months of supply. The one exception that's getting toward a balanced market is our friends up in Bemidji with 4.5 months of supply. But you'll see regions with, one, you see a couple, 1.8, couple 2s, and lots of 3s. So just something to think about there. All housing is local. So what's happening on the Iron Range? Seeing some layoffs, is it Mesabi and Cleveland Cliffs? So some challenges around, trade and some of the changes we've made around our economy. And so we saw 2 stories about some economic challenges up there. Hop down to Rochester around the Mayo and all the other excitement happening down there. And you'll see some of these headlines, right? Outpacing the rest of the state in jobs, verge of a residential construction boom, seeing the fastest growth in Minnesota. And so those 2 communities, wonderful communities, are both sort of squeezed together in our statewide metrics. And so I just want to say there's a lot of regional variation across different geographies. Speaking of regional variation, it's not just across the metro and across the state, it's across the whole nation. Florida is seeing record high inventory. We just saw we aren't even back to pre-COVID levels. And then Texas as well. And just another way to visualize that, in red you've got Florida and Texas inventory combined, and then you've got all the inventory in the entire Northeast. By the way, the populations are pretty similar in these two geographies. So very, very different things happening. All right, let's pivot into some of our insurance and a couple tax slides. And want to acknowledge, we know there's some committees and other groups who are sort of looking at insurance and taxes, and so won't claim to be the expert on that, but I do want to show you some of the data that we're seeing. So this is the average annual premium per $1,000 worth of coverage. So multiply that by 300 to kind of get your typical amount, and you can see the change. You can really see the change just over the last 3-4 years in terms of the cost of insurance. Next time I'll visualize this a little better, but you can kind of see over time, over the last 22 years, 20 years plus, you can see that typical insurance payment as part of the principal, interest, taxes, and insurance payment. And again, over the last, 4 or 5 years, from $1,600 to $2,500, that's a big change, on top of rising prices, higher interest rates, and some of the tax challenges that I'll show in just a minute. Some might think, well, we're not in the Gulf, we're not in Florida, we don't have hurricanes, and that's true, but we do have flooding, and we also do have hail, don't we? And so I think you see that reflected in some of the premiums and some of the dynamics around rates. I won't go any deeper into that one. Just kind of looking at the change, we are toward the higher end. You'll see some California, North Carolina, maybe some surprise to see Des Moines in there. but we are toward the higher end when it comes to the change in premium or the change in insurance payment. Yeah, this one's not as exciting, but HOA and condo fees, obviously not totally, but largely, I should say significantly dictated by insurance needs, exterior, interior. So you can kind of see how HOA dues and fees look in Minnesota, $269 versus, all right, New York and DC are higher, Hawaii is higher, but we're pretty close to California, and are we over Illinois? And you can kind of see our upper Midwest neighbors, Michigan, the Dakotas, Wisconsin. And so a challenge for people, we mentioned the condo townhouse. There's some promise in that segment, great first-time buyer segment, but there are challenges around this very topic. And again, sticking very briefly on that idea that the principal and interest portions are starting to turn a corner because we see prices leveling out and rates coming down. So the principal and interest payments are starting to sort of heal or recover, but it's the taxes and insurance pieces that are sort of negating that or canceling that out. And just a very quick way of saying, don't forget utilities, right? You gotta heat your home and power it as well. We won't get into proximity to data centers or anything like that, but just know some of these costs continue to rise, obviously. Taxes, I will not go through all of this, but another cost driver. And again, that second taxes and interest component negating improvement in the principal and interest piece. So what, the levy looks like about a 6-7% statewide increase. Remember, inflation's about 2.8 or 3, and so we're really looking to minimize this impact on homeowners if we can. Let's keep trucking on that. And then, yeah, just sort of a fact here. One of the challenges, perhaps the biggest one, is that commercial values are still down because of higher vacancy rates due to remote work. But home values continue to rise. So more of that tax burden, that levy, is shifted from commercial back onto residential owner-occupied homeowners, causing kind of more stress, more strain, and harming affordability further.
I just want to jump in here quick,
Yeah,
Mr.
please.
Arbit. We have about 15 minutes left, and I've already got a list of questions from members.
We've got questions.
So I just want to say, maybe if you want to try and wrap up the next couple pages here in just a couple minutes, because I
Perfect.
know we got some good questions here.
Thank you, Mr. Chair. Absolutely, will do. And we were rounding, just about to round. I'll skip a few of the maps. We'll make sure staff have them. We'll make sure you guys get the links on those because they are neat to see and pretty educational. I'll wrap with these few. We asked the question, where did all the homes go? Did this inventory shortage just fall from the sky, or did we kind of cause it ourselves? Well, why don't we look at population in Minnesota in blue and look at housing permits in that kind of purple rain color? Well, we were keeping up with population growth until the Great Recession, and then we weren't, right? So how did we get here? We have more people, and we didn't build enough homes for them, right? It's pretty simple. Some of you understand that maybe our tax and regulatory environment here could be a little different than Wisconsin, so I've also plotted Wisconsin in that sort of yellow cheddar color, and not a big difference. So I'll just go back and forth. Here we are, here they are, here we are, here they are. Not a big difference. All right, last few. One of the ways we think about this is housing demand is cyclical. Housing supply is structural. When I say cyclical, we can create a home buyer overnight. When interest rates went from 6.1 to 5.9, you can create a buyer overnight, a bunch of buyers. Can we build a new subdivision for them by tomorrow? Can't do it. So it's a good way to sort of think about that. Demand is the weather, supply is the climate. Let's see, and then just very briefly, what's gonna happen with rates? These are people smarter than I am. Most are saying low sixes. I know that's a big question. Most are saying low sixes. And then last one, sort of our official forecast. The market has challenges. A lot of homeowners are stretched. We don't think of this as a broken market, but more of a normalizing or a rebalancing market. And really getting back to the fundamentals. Jobs, incomes, demographics are big drivers. Inventory, supply, demand. Lending standards are far better than they have been in the past. And we think that this will be another kind of rebalancing transitional year. And with that, Mr. Chair, I yield back.
Thank you. Well, first off, thank you for the fantastic presentation and getting through all that information in the time you did. That's very, very impressive. First on my list will be Representative Nash.
Thank you, Mr. Chair. Mr. Arbit, it's always nice to see somebody who has a more greater penchant for data than the entire committee put together. So that's great. But one of the questions that I have, and you don't have to answer this now, but maybe get back to us, is I know that you've got colleagues that do the same thing that you do in different states and different cities around the country. What I would like to see is the states that have addressed the permitting restrictions, the permitting difficulties head on and are seeing great growth. I would love to see your analysis that you've just shared, maybe a few less slides, but look at the data in the lens of those that are being aggressive on deregulation versus where we are here in Minnesota. That I think would be very illustrative for this committee as we move forward with trying to convince enough people here to put up votes to change the landscape of our housing market.
Yep, good point.
Is that
Thanks,
something you feel like you can do?
Mr. Chair? Yes, I do. Yes, I do. And I think it would be good to benchmark that maybe against the Midwest because we're really different than Florida and Texas like we saw, but it would be nice to sort of compare that. I think that's something we can do. Yep. Thanks, Representative. Mr. Chair?
Okay. Next on the list will be Representative Johnson.
Thank you. Thank you, Mr. Chair. Thank you for the presentation. I think maybe you touched on a little bit. I live out in Washington County, Cottage Grove, so it's just basically a right turn into Wisconsin. So, so I'm just wondering how much, I was just wondering when, at what point do we start just bringing in that part of Wisconsin into the Twin Cities discussion as far as, so we can start seeing what are those homes, because a lot of people in my county are just moving into Wisconsin, which our roads are showing it. That's why we're constantly asking for bonding money, because we're being overwhelmed with coming across the bridge. And so I'm just wondering how many people, or what are the housing pricing over there? Like I said, so many people are just moving over across the border and working in Minnesota but living across the border. And what are the houses like over there, and as far as that? So thank you.
Mr. Arbit.
Yeah, thanks, Mr. Chair. Representative Johnson, it's a really good question. We've heard of, what do we call it, border hoppers, or, kind of folks who think that way. Interestingly, St. Croix and Pierce counties are technically part of the Twin Cities census region. So it's part of the metro technically, but it's obviously not part of the state. So, and the metro, the MSA, the Census Bureau, bases that on labor sheds and commute sheds of kind of who's going where for work. And they've sort of gobbled up those two counties. It would be interesting to see what percentage commute here versus stay, in Wisconsin, on the Wisconsin side. I will have to look at, our MLS does have those two counties, but it doesn't have all Wisconsin. So I'd want to look more deeply at that. But where there's inventory and better affordability, I think people are looking at more closely, even if that means compromising on location or other things. So I think you're not the only one to think that or notice that could be a trend that we're seeing. Yeah, and the truth is, anywhere we can build more homes would be helpful.
Any follow-up, Representative Johnson? Thank you. Next on my list is Representative Scrava.
The obvious question is, if interest rates drop, are we ready? And on page 56, slide, or whatever, 56, preliminary property tax levies for 2026, you show everything going up 8%, 8%, 5%. Perhaps you can answer my question, why?
Mr. Arbit.
I might punt to my friend Paul over here.
Mr. Chair, Representative, I wish we could tell you why. The numbers are the numbers. We took those directly from the Department of Revenue. So, I mean, all politics is local, all property tax decisions are local. So you'd have to, kind of take a look at what's happening in each of those taxing jurisdictions and figure out if there's something unique there or if there's a statewide trend.
Representative Scrava.
Because one of the questions when you're sitting down with a first-time homeowner and you're working the numbers out, this is what your monthly payment's going to be. And after you put the insurance in, the utilities in, they look at each other and say, maybe we got too much of a house. And then you put property taxes in, and now they're like, okay, we can't live here. That's anecdotal. There's no facts in that. It's just, I hear it, I listen to people, my younger friends who are doing this, and it's frustrating because they both, the couples that I know that are doing this, they're both working and they're both saving money and they both have the money, but when they sit down and do the math, and they're in their 20s, it's like, no, we still can't do it. We can't do it. And it's almost like there's an actuarian running around making sure that no one under 30 is buying a house because they want to make sure that that number stays high. It feels weird to me because you think you're both got really good jobs out of college, you got enough money, and when you start doing the math and doing this, adding everything up, it just becomes unattainable.
Yeah, Mr. Chair, Representative Scrub, I think you make an excellent point. I think that's the slides in your packet. When you have a chance, if you go back and look at the monthly payment slide, it's stark, and it's something that, you know, when David first came up with that slide a couple of years ago, that one jumped out to me immediately as one that we need to pay attention to, because that monthly payment is just, it's getting outrageous. And that is a problem, and it's a problem for young people. It's borne out in the data that David went over on the median age for a first-time home buyer. It's tenure in your home. You know, it's all these other metrics, but that one is the one that I think we really need to keep an eye on and moving forward in the future.
And if I could just jump in, I would love to have those numbers pre-tax, or not pre-tax, post-tax. Because something tells me that percentage gets a lot higher.
Mr. Chair, everyone's tax situation is a little different based on capital gains or your marginal buckets, but I think we could make some assumptions to look at that. Yep, I do.
Thank you.
Yep.
Next on my list will be Co-Chair Howard.
I'll be brief. I just want to thank you so much for this presentation. And I remember getting a similar presentation last year. And just a comment, I'm struck by the picture that you painted last year was very similar to this year. Only now we have one more year as a legislature to admire the problem. We didn't take a lot of action of things that were in our control last year, and now our average homeowner, first-time home buyer is up to 40. And so just putting a marker down that we have to stop admiring the problem and focus what's in our control. And I appreciate that the comment during the presentation about what can we focus in our control here? We can make it easier to build homes, because so much of the data just underscores that basic premise that we don't have enough homes. And the slides that I just wanted to call out for us that I found this year especially interesting is related to inventory. You know, that what we're seeing in terms of inventory needs are the greatest at the lowest level, or for lower and middle income levels of home ownership. But what we're actually building and what we're allowing is the exact inverse. We're seeing more activity in the luxury side, and more activity there than the lower side. And so, again, that screams out for there's a problem, and we just have to quit admiring the problem. And I think we will, so I'll get off my soapbox. We have more time for that soon, but couldn't pass up the chance. And again, this data is really helpful. And I think I made this plea last year, keep this presentation, because it's really relevant to the discussions we need to have this year.
Seeing no further questions, I just have one more that I wanted to ask. And it goes back to those, the lower price homes, right? You're under 100,000, under 200,000. And I know this is kind of be a tricky question for maybe you to answer, but you know, for the longest time, you saw so many homes listed in probably that $75,000 to $150,000 range that were your flippers. I grew up flipping houses with my parents. They're gone, right? If I go look on any of the major websites and that. So my question is, what happened to them, if you can see through your data, or like what inferences can you make to that?
Yeah, Mr. Chair, it's a really good question. I kind of alluded to many have just appreciated out of that group. So I used to be in the 30 to 39, now I'm in the 40 to 49 cohort. We just kind of age into the next cohort. So appreciation, some of the really bargain priced ones have probably been scooped up and flipped, I think, like you alluded to. Mm-hmm. I know some were doing Airbnbs. I don't want to speculate too much because our data doesn't show kind of what share is happening, you know, how many are kind of going to what. But you don't find a lot of $80,000 homes anymore. Maybe a couple, maybe not in your district, Mr. Chair, but maybe, you know, maybe the Hibbing, Virginia, you might see some 80, 100, 120, not a ton. And I think that's just reflective of how much prices have changed. Replacement value, the fact that they're not being listed if you own them, so they've appreciated, but they're not coming onto the market. So a multitude of factors. Yeah, it's a really good question.
Well, and it's just one I mentioned because I think that's not just something that made Minnesota great, but really our country in a lot of ways, the ability for people to go in, buy homes, put in the sweat equity, and then build themselves into that next home, build the generational wealth. And just as much as we talk about having to build more affordable homes and make sure we have a supply, like that's a missing part of the equation that frankly, I don't see coming back for a long time. And that's concerning because that was the avenue for someone to go to a Home Depot or a Menards and make something. And I feel like we don't talk about it enough, and I think this committee needs to talk about it more, that's a missing part of who we are as Minnesotans. So thank you for that answer, and thank you again for coming in all this data, because as my co-chair mentioned, we're gonna be doing a ton of work trying to get at that supply problem. And there's things in here that we can't change overnight. When you see 10, 11, 12% appreciation on homes, once it goes up, it doesn't really come down. I'm not saying that's a bad thing, but, you know, it has its side effects. And now, when it doesn't match inflation, when it doesn't match wages, and when it doesn't match the fact that the cost of living has gone up due to multiple factors in the state, that's why it's so fun to work on housing. Because even though our purview in statute is small, our reach is large, because just about everything we do in our daily lives affects what we can do for housing. So thank you to both of you. Thank you to all the realtors for the work they do across our state, because this data is incredible. So thank you again for being here today.
Thank you, Mr. Chair. Yeah.
With that, members, we've concluded our agenda. Is there any further questions or comments? Seeing none, we are adjourned.